I'm about to share with you why 2025 will be the year savvy investors strike gold in apartment investing. You're about to see powerful data that most investors are missing. The apartment market is setting up for one of the best buying windows in over a decade. What I'll show you could change how you think about passive investing in real estate. This isn't hype, it's market timing, math, and macro trends. I'm Maria Zondervan, CEO of Blue Vikings Capital. I help high-income professionals build passive income. I don't just talk theory. I help you get access to real deals that I myself invest in. And I've always loved investing in apartment complexes, but now even more so. In this video, I'll walk through 9 market forces aligning right now. Let's start with number 1. Real estate is on sale. Multifamily values have dropped 10 to 20% from their peak in many markets. Some sellers are over-leveraged and need to exit. In many cases, they're having to sell at a loss. This is one of those rare moments where buyers have real leverage. It's like walking into a clearance rack with long-term upside. Reason number 2. We're near the bottom of the real estate cycle. Real estate always goes through cycles. In the last few years, we saw rents escalate very quickly. As that happened, more apartment complexes were being built. Then it reaches a peak, and that's a great time to sell. Then we see rents decrease due to all the new inventory created by the newly built apartments. This is a typical demand and supply curve. Now we're seeing rents level out and stabilize, which means we're at the bottom. That means it's time to buy, because soon it will start all over again and rents will increase. This is the phase smart capital enters. Buy low, ride the next expansion. Buying now positions you for value appreciation and cash flow. Reason number 3, apartment construction is at a 10-year low. Far less permits for new constructions are being pulled. New supply is drying up due to high interest rates and expensive materials. Put simply, it's too expensive to build right now. Plus, in some markets, there's a literal construction freeze. And in other areas, they overbuilt, so it didn't make any sense to build anymore. Keep in mind, it usually takes 2 years or so from the time a permit is pulled to time they actually have move-in ready units. This slowdown constructions has been happening for a while now. So now we're all seeing less and less new apartments being delivered to the market. But in growing markets, demand is already coming back. And with no new apartments coming online, the concessions offered by previously newly built apartment complexes, things like get first month's rent free, those are concessions. They are beginning to reduce as the units are filled and demand is increasing. So in short, limited supply equals pricing power for the existing operators, right? So reason number 4, apartment demand is surging. I already hinted at this, but don't take my word for it. Take a look at the Q1 for 2025. It had the strongest net absorption of apartments in history. Why is this happening? Millennials and Gen Zs are renting longer than ever. They simply aren't interested in home ownership as the previous generations, or not as interested. Or they can't afford it. We'll get to that in a minute. And those home ownership delays are driving sustainable rental demand. So multifamily isn't just holding up, it's leading. Reason number 5, home buying is the least affordable ever. First-time home builders are priced out. The price of a single-family home has risen by nearly 200% since 2000, but income has only risen 40% in that same time frame. So it takes a lot longer to save up for a down payment, and you need to be in your job longer to get a salary where you can actually afford your first home. When you compare the cost of a mortgage to be able to own a home versus the price of renting, the choice is pretty obvious. The average mortgage payment is around $3,000 per month, while rent is around $1,800 a month. The result is a clear preference shift. So the affordability gap is widening and renters are staying renters longer. This fuels long-term apartment demand. Reason number 6, competition is the lowest in decades. Institutional lenders pulled back in 2023 and 2004, requiring larger down payments. This, coupled with higher interest rates, meant decreased buying power. So with less buyer activity, you get more favorable deal terms for those that stay in. Fewer bidding wars, better pricing, and more upside. And we're seeing more off-market and direct-to-seller deals. Which leads to reason number 7. Reason number 7. Amazing buyer and investor terms. Sellers are offering rate buydowns, carrybacks, and creative financing. This is a rare moment to negotiate both price and terms. Lenders are now competing for safe, stabilized deals. And since some lenders pulled back, it left more room for private capital from passive investors like you. With the right sponsor, your money can go further today than 2 years ago. Reason number 8, outstanding tax benefits and potentially getting even better. Real estate has always been the clear winner when it comes to tax benefits on your investment dollar. Real estate investors have so many avenues to legally reduce taxable income significantly. All the operational losses are deductible. You can do things like 1031 exchanges to defer capital gains on investment properties you sell. And you can even invest via tax-deferred or tax-exempt IRAs or 401ks. But by far, the most benefit comes from depreciation. And on these larger deals, that can be massive because the bank is the biggest partner in these deals, usually bringing 65 to 80% of the money needed to buy these apartment complexes. But the banks don't get any share of the depreciation. That means all of us investing in these deals, and thereby becoming partial owners, get the depreciation for the entire value of the buildings, not just the portion we paid for, but the bank's portion too. As if that wasn't powerful enough, these larger deals can afford to do cost segregation studies, which means accelerate depreciation. Meaning instead of taking a straight depreciation across the 27.5-year useful life of these buildings as defined by the IRS, we get a disproportionate amount of that depreciated in the very first years. But it doesn't stop there. Right now, we still have something called bonus depreciation. The current administration is promising that that's going to go up to 100%. What does that mean? It means that 100% of all the building components identified in that cost segregation study I just mentioned can be depreciated immediately upon the purchase of the property. In most cases, that gives you enough of a write-off on your taxes to not only ensure you don't pay taxes on the income you are earning from that investment, but potentially on the income you're earning on other passive investments as well. And in some cases, even active income. Now, I'm not a CPA, but I know people who invest solely for these tax benefits, and the income they make is a mere added bonus. So you should definitely talk to your CPA about these benefits and how they could apply to you. Okay, we're at our last reason why apartment investing is going to kill it in 2025 and probably 2026 too. Reason number 9, recession and inflation favors apartments. I'll say that again. Recession and inflation favors apartments. Many economists predict that we are headed for a recession and that inflation will begin picking up steam. Apartments are a recession-resilient asset class. Inflation pushes the cost of everything up in our lives, from a carton of milk to the gas you put in your car, and that includes rents. Apartment complexes are valued based on the income they produce, so when rents go up, so does the value of the apartment complex. That's why people investing in them generally double their money in 4 to 6 years. The value isn't determined by comparables like with single-family homes, but rather by the income. And that's something that can be forced up with renovations, or we can let inflation do it for us. Ask any economist and they'll tell you that hard assets are where you want your money to be during recessions. Also, more people rent when times are uncertain. Real estate also offers protection against currency erosion and volatility during turbulent times. So let's recap why 2025 and 2026 will be a goldmine for apartment investors. You have 9 forces colliding in your favor. Prices are down. We're in a buyer's market. Supply is shrinking. Demand is booming. Ownership is out of reach. Competition is low. Sellers and financing is flexible. Taxes work in your favor, and apartments thrive in economic turbulence. Now is the time to act. Not later, not someday. This is the start of the next cycle. To help you with that, I have a free guide called How Smart People Build Legacy Wealth Passively that you can download right now. Just click the link. If you're a high-income earner looking for truly passive income, if you're tired of market volatility and want tangible tax advantage assets, Visit bluevikingscapital.com and learn how easy that can be. I hope to invest alongside you in 2025. Let's build our wealth together.